So we just closed on more than 100 units in the last 6 months. We did an 89 unit deal last month and 20 units earlier this summer. And so in this video, I just want to show you how I think it's actually easier. The road to 100 doesn't have to go one at a time, but really in just a few months, you can be over that 100 unit mark, having positive cash flow, really starting to build wealth in large apartment buildings. So I'm going to break down these deals, how we did it, how we structured them, and how I think you can get started doing the same exact thing in 2022. Let's roll. Hey, so as I mentioned, we just surpassed 100 units this year, buying our 89 unit deal in Kansas City, our Windsong deal, and then 20 units earlier this summer, our Bay Park deal. Maybe we'll post photos of both of those so you can see those. Here's the first question you got to ask to go big is, are you okay sharing? Are you okay joint venturing and partnering? Or do you just want to be on your own and do smaller stuff and do all of the work and all of the risk? I love the analogy, like I'd rather have the juice of a slice of a watermelon, right, than an entire grape. Right, the juice is worth more of the squeeze in one slice of a watermelon than an entire grape. And I think the same is true with real estate investing, is why we like going after larger assets. And so now we break these down when we buy deals, and I want to show you how we do this, because this structure allows us to go out and buy large commercial real estate deals. We have a partnership between our company and our investors, and typically that partnership is something along the lines of 70-30 split, meaning this: we give 70% of the deal to our investor base. So those who are investing with us get 70% of our project, of the cash flow, of the appreciation, of the depreciation, and then me and my company and my partners own 30% of the deal. So I'm not going to talk too much about this today because this is pretty self-explanatory. We give 70% to our LP, to our limited partners. They get 70% of everything, okay? What's really key though is how you structure this, because we can begin to break this out into other things and bring on other partners as well who can help us find deals, who can help us raise more money. So that's what I want to be talking about today. So what I think is a lot of people just kind of hung up is, Ellis, I don't know how to go find deals, or I don't know how to raise money, or I don't know how to manage these deals or underwrite these deals. And this is where joint venturing and partnership comes into play, and how you can begin to carve out this 30% to other people who have strengths that are complementary to you. All of my partners, which is why we formed a partnership, we have totally different strengths, right? None of those guys are on camera today, right? But they're the guys who are really strong in underwriting and really strong in asset management. And if you don't want to maybe start a company, then go find those partners. And I'll show you exactly how you can begin to structure this type of stuff so that you can bring on more people and start doing bigger deals. We kind of break it down in a couple different ways, and typically this is how we do it. I'm just going to show you, of this 30% that we own in this management, this gets broken down in a couple different big chunks so that we can bring on other people. One of the biggest ways that these deals happen is through private equity. So we need somebody to go raise money, or we're going to go raise money for the deal, and typically of this 30%, we're going to give around 27% of that for the money. Okay, so you have 27% carved out of the 30 for someone who's going to go in and bring in investors, right? Who's going to bring in this group over here. And then for these deals, you're going to have to sign on the loan, right? You need somebody with experience. You need somebody who has liquidity. You need someone who has a net worth equal to the size amount of the loan. And so for that, because this person's taking on risk and they're bringing in, they're putting their name on the loan, we're going to give somewhere between 10 and 15%. So let's call that 10% of the deal, right? And then you have pursuit costs, meaning you're going to spend money, and sometimes to buy these commercial deals, you're going to have to put money down up front because the seller's going to require that. And so that's going to be somewhere around 5%. We're going to give someone 5%. By the way, this could be all of our company, right? We are doing a lot of these roles, and so we're getting a percentage of all of these different numbers, but I'm just showing you what this is. So this is what we call like a loan guarantor, or a KP. This is someone who's putting down the earnest money. And then you have the controller, who's going to be managing the asset on the back end. And that's a really significant role, right? Who's going to be overseeing the deal, and that's a big chunk of this. And so that's somewhere going to be around 40%. So what are we at right now? We're at 50, 55. about 82% right now. And so the other thing just comes in one in finding the deal, right? So that other 20% or so, I'm just going to call it roughly 20%, goes to finding the deal, underwriting the deal. But as you can see, you can break up this 30% into people who can raise money, sign the loan, bring in cash that you need, manage the asset, underwrite the asset, right? And so begin to look for partners who can be complementary to you to take down larger deals. What if all you're good at is just finding deals, right? So then you could carve out 5 to 10% of the asset for just finding the deal. Well, what if you're really good at just marketing and talking to people, or maybe you have a really good network of people who have money who might want to invest passively? Well, guess what? 27% of this general partnership could be yours for bringing in equity and managing those investors. And so all of this is how we get deals done. It's how we've been able to accelerate our path, because we're not doing everything. We're splitting this, our company, with other joint venture partners who can help us find deals, who can help us raise money, who can help us asset manage deals in markets that we're not living in. And so this is how you scale to 100 units, 1,000 units. I mean, we're way past 100 units, and we just did 100 units in the last few months. We're closing on another 351 units this month. The biggest deal we've ever done. Why? Through joint venture partnerships. Because we know what we're good at, and we bring pieces of the deal to the pie, or pieces of the deal to the puzzle, so that we can get bigger things done and start accelerating our growth and building our wealth. This is how you think wealthy. Thinking bigger means you're going to run into more problems, which is why you're going to need more people to help you solve those problems. Remember that. We want more problems, which means we need more people, which means we need to be building relationships. This is the key to thinking wealthy. If you like stuff like this, be sure to leave me a comment and hit that subscribe button and keep following along. Cheers.